I was in Japan last month, and everywhere I went, people went on talking about one thing: Japan's economy. Then the headlines started piling up. Capital flowing out of Japan, the yen carry trade at risk, warning of a global market shock. And it made me stop. If Japan feels so far away, why are investors everywhere suddenly so nervous? And why should this matter to your money? So I dig in. Reports, data, and conversation with people managing portfolios every day. The Japanese yen may be one of the biggest hidden risks in markets right now, bigger than falling tech stock or a shaky housing market. When it moves, it can hit asset prices, borrowing costs, and even what's quietly sitting on your ISA and pension. In this video, I'll explain why the yen matters and what you can actually do about it. I'm Raf. I worked in investment in London for years, and I'm also a chartered accountant. And if I'd understood this risk earlier, I would have invested very differently. So let's get started. Japan isn't just big, it's the fourth largest economy in the world, and it's home to some of the biggest investors out there: pension funds, insurers, and banks, quietly moving trillions across global markets. For decades, Japan has done something unusual with interest rate. While the US and the UK raised and cut rates across the cycle, Japan kept them near zero, even getting negative in 2016. So borrowing money was almost free. Why? To revive an economy that has been stuck for years, because cheap borrowing was meant to encourage spending. But here's where it starts to affect you. Cheap money at home pushed Japanese investors overseas, sending trillions of yen into the US and European markets. When they buy foreign assets, price rise. When they pull money back, markets fall. Their bond buying affect yields and borrowing costs globally, and because the yen is heavily traded, these flows can also move currencies as well. Now, even if you've never owned a Japanese stock, part of your portfolio is already tied to Japan, and this influence is actually huge. Japan is the largest creditor nation in the world and the second largest foreign holder of US government debt, just behind China. That sets the stage for one of the most important strategies in global markets: the yen carry trade. This term is scary, but the idea is very simple. Borrow where money is cheap and invest where returns are higher. First, investors borrow yen around a very low rate, say 0.5%. Second, they swap yen for dollars or pound or euros, whatever, which moves the exchange rates across the globe. Third, that money goes into US bonds, corporate debt, and US equities, for example. So where's the risk? The trade only works if currencies stay stable. But if the yen appreciate, losses can be massive very quickly. Say you borrow some yen to buy your brand new house worth £300,000. If the yen appreciates a lot before you repay the loan, that same house could suddenly cost you the yen equivalent of £500,000. That's the danger. When conditions change or the Bank of Japan shifts policy, traders rush to exit all at the same time. So the process looks like this. You sell foreign assets, you convert the money back into yen, the yen appreciates, your losses grow, therefore more for selling, which then appreciates the yen. It just becomes like a feedback loop, and it just makes it worse for everyone super quickly. Now, that kind of unwind can sit quietly behind sudden market drops, even if headlines blame, something else. And it's not just theoretical. In August 2024, the Bank of Japan raised rates and signaled more to come. Traders rushed to close their carry trades, and the result is that the S&P 500 fell 6% in a single day, which is super rare, and the Nikkei dropped 13% shortly after. Now, other factors also mattered, but the yen carry unwind amplified everything. And if your portfolio dipped sharply that month, the yen likely played a huge role, even if you never heard about yen before. Now, today, which is quite interesting, further rate hikes are still on the table in Japan. They just got a brand new government, so the risk hasn't gone away. So how does this impact your life? For years, cheap yen helped fuel global markets, especially US equities. And if Japan raised rates even further, money can flow back to Japan very quickly. That means that stocks can have a shocker of a day, especially when tech names have been overvalued for a long time. Bond yields can rise, which push mortgage rates higher across the world. And even small yields move can add thousands per year to borrowing costs, say like your mortgages. Japan's influence reaches further than most people can realize. Now, you don't need to trade currencies, but just stay aware. First, I would watch Japan very closely. Did the Bank of Japan change rate or guidance? Is money flowing back home? Is the yen strengthening fast? Second, I would have a look at the bond yield curves occasionally. Think of it like checking the weather. You're not forecasting, you're just having a look at what's going on today. And third, stay diversified. This isn't about panic or, selling everything. So ask yourself from time to time, if the music stopped today, how exposed would you be? To recap, one of the most overlooked risks in markets is a currency, the Japanese yen. When it appreciates, equities can wobble, yields can rise, and borrowing costs can get more expensive. But you don't need to predict it. Your money is global and the yen is part of that map. If this helped, like and subscribe. I'll keep breaking down how global markets quietly shape your everyday finances.